everybody, and good afternoon. Welcome to our session today, Managing Forests for Carbon, How This Mature Market Continues to Innovate. So this session, I'll read the theme of our session here, is described as from carbon storage to managing for wildfire risk. The forest sector has historically played a strong role in producing climate benefits on natural and working lands, as well as generating other co-benefits. Today, market players are working to innovate in this space, coming up with insightful ways to bring these benefits to more landowners and communities. So in our session today, our speakers will discuss what is currently being done, how projects continue to innovate, and what the future holds for forest management to continue playing a key role in the fight against climate change. My name is Lauren Cooper. I direct the Forest, Carbon, and Climate program at Michigan State University, and I'm really delighted to be the moderator today. And we have three speakers, but before I introduce our speakers, I wanted to make a quick note that we are hoping to get your questions and comments throughout the session. So we'll have all three speakers, but please feel free to put in questions at any point so that we can organize them, and we don't want you to forget your questions for our earlier speakers if you wait all the way to the end. So if you've been to some sessions now, hopefully you have the hang of the interface, but in the top right corner, there's an arrow and a bar. So if your sidebar is not extended, you're not going to be able to see this place to chat or to have Q&A session. So make sure that this sidebar is coming out. So once you expand it, you'll be able to chat in either the whole event or in our session. So there's two tabs on top. So make sure that you click in our session, and then your question in the chat will be visible to just in the space. So hopefully we can all navigate there. But so now to go, and again, feel free to please put in questions at any point. So to now introduce our speakers, we're going to hear from Jim Clark, who's the president of North Coast Resource Management, and he's been practicing forestry since 1992 and has been working on the development of both voluntary and compliance offset projects in the North Coast of California since 2008. North Coast Resource Management has developed carbon projects across approximately 150,000 acres and brought over 11 million carbon offsets to market. In addition to carbon project development, NCRM provides traditional land management, environmental consulting, and conservation planning services. Jim received a Bachelor of Science in Forestry from UC Berkeley and has been a California registered professional forester since 1995. Our second speaker today is Karsten Turner, who's the Vice President for Conservation and Stewardship at the Pacific Forest Trust. Prior to joining PFT, she spent 20 years working in the fields of forest investment, stewardship, and management. She has a background in both forestry and business, and working with the Forestland Group, a timberland investment management organization. She catalyzed, led, and managed the conservation of millions of acres of TFG land. As a native of California and, I don't know how to say it's county, Siskiyou County, with roots in Siskiyou County, Karsten has worked in forests throughout the US as well as internationally, assessing them for their conservation values from wildlife habitat to water services for climate and carbon values. And finally, our final speaker will be Daniel Sanchez, who's an engineer and energy systems analysis studying the commercialization and deployment of energy technologies that remove CO2 from the atmosphere. His work and engagement spans the academic, non-governmental, and governmental sectors. And as an assistant cooperative extension specialist, he runs the Carbon Removal Lab, which aims to commercialize sustainable negative emission technologies and supports outreach to policymakers and technologists in California and across the United States. So we're really excited to hear from our diverse panel, and we're glad to have Karsten on camera as well. So that's great that we're all here and settled. So I'm going to hand it over to Jim now, and we'll hear from Jim first, and again, then move to Karsten and Daniel. Thanks so much.
Yeah, thank you. So I came into the carbon world from the perspective of the forest landowner, starting my career as a practicing forester in California, and developing a business with a broad range of clients, ranging in size from small landowners with 40 acres to landowners with over 100,000 acres. And so with the Climate Action Reserve creating protocols in around 2006, 2007, and working towards protocols that would eventually be adopted by the California Air Resources Board, my clients became interested in looking into carbon as a an opportunity to create a revenue source that didn't, rely on traditional timber harvesting, which is subject to market fluctuation and, markets that come and go, like export markets, where one year you can sell your ponderosa pine and the next year you can't, or you can't afford to. So, starting in 2008, started looking at these protocols and, very technical stuff, something that I was, turns out very interested in and able to pick up and run with. Started some projects under early action with the Climate Action Reserve that eventually transitioned into compliance projects under the Air Resources Board's protocols. The majority of the projects I manage right now are compliance projects, just because that was, that was the game that people wanted to get into. That's where you had a market that you could access. Wasn't always easy and still isn't, but that was, that's where people started out looking. So some of my traditional clients kind of steered away from it at the beginning. They weren't really sure. They were scared by the long time commitments, the uncertainties of the protocols early on, when there was a lot of kind of ups and downs and regulatory challenges and lawsuits kind of plaguing the program. So as the market has matured, some of those clients that were a little hesitant early on came in, and came around and decided that, well, maybe carbon projects are something we want to look into. Maybe they had a large land holding, it's a family ownership, they have a complex structure of owners, and they need some sort of revenue to kind of keep the land together. They have tax bills every year, they have to keep everything going, and their only other option really is to go out and harvest timber. And in California, that's not a simple thing. I mean, it's fairly involved. So in terms of complexity, it's less complex than carbon projects, but still, it takes a significant commitment to land management. You have to, have a forester, have a plan, work through quite a few hurdles. So, they saw carbon as an opportunity to develop a revenue stream that didn't involve, constantly writing harvest plans, spending money, and maybe not doing anything because the market didn't develop. So that's really where my clients have come from, and they use carbon as a means of managing the land, keeping it in a family ownership, keeping it as open space, and really not necessarily changing the way they're managing the land, but taking credit for that management that they're doing. So some clients maybe have been in the past not, they've been harvesting lightly, even when they could harvest more. So a carbon project gave them an opportunity to kind of monetize that kind of stewardship and that sequestration that they had been accumulating, even though they weren't really planning on it being, sold as carbon or marketed as carbon. That's what I've kind of been doing for the last 13 years at different levels. And now, I see clients who are, they're looking at kind of the voluntary market. Even though compliance projects in California are technically voluntary, they're not, it's the market for those credits is is sold to compliance entities. So clients are looking into this larger voluntary market, which has been developing, but it's been fluctuating up and down. Obviously, COVID hasn't helped that. That market space is kind of up and down. But I see my clients still looking into, getting into this voluntary market and looking at other options for joining the carbon space other than compliance projects under the Air Resources Board, which have a high level of complexity, a long time commitment, and they're very expensive to develop, mainly because of the regulatory oversight by the Air Resources Board, which requires a super high level of scrutiny of both the project development and the verification of these projects. So clients are looking towards other protocols and methodologies that are voluntary, that have not necessarily less complexity, but fewer hurdles in terms of the size of the project. Smaller projects can participate, and the length of the commitment to the carbon, to monitoring your carbon stocks over time, and also looking into more creative ways to fund conservation that works with their other conservation strategies of, say, expunging development potential and maintaining larger landscape size properties that can continue to function as working forests, and that don't get broken up into 160 acre parcels, and where other uses become more valuable. So lately I've been working with the Climate Action Reserve through the Climate Forward program, and I work to help develop a mature forest management methodology that works with landowners looking to use a conservation easement to secure kind of a future condition of their forest. So the conservation easement would lay out restrictions on forest management that would guide the development of the forest over time, to include stands with higher volumes per acre, dominated by trees of larger sizes, and maybe with a species composition and stocking levels that are, designed to mimic a more mature forest. And through this conservation easement process and through the methodology, the landowners can take credit for this future condition kind of right now, through an ex-ante type crediting process, where you're taking credit for that future condition now and securing the project with the conservation easement, which is perpetual and is monitored by a third party, the easement holder, land trust generally. And that level of protection through the conservation easement creates this insurance that the project will in fact develop in the way that the landowner intends, because any future owner of the land would have to follow the terms of the easement. And if they did harvest, they would have to incorporate the terms of the easement into the harvest document and follow whatever restrictions the easement includes. So this kind of follows along the lines of where I see kind of innovation in methodologies and protocols that look to reduce cost, increase access to smaller landowners who don't own 5,000 acres right now. That's probably the smallest size that a compliance project could be in California in order to try to justify the costs of developing the project. And also looking for protocols and methodologies that reduce regulatory burden of kind of maintaining the project, and reduce those management costs over time, so that landowners aren't discouraged from participating just because they don't want to be saddled with a 100+ year commitment to monitoring and very rigorous reporting and very rigorous oversight. So so clients have been looking to voluntary projects outside of the compliance market, but there's still hurdles there, because there's access to voluntary markets. There aren't marketplaces where you can go find a buyer. So finding a buyer for a voluntary credit is still a challenge for small landowners, unless they're going to work with a project developer that has developed those relationships and can find a spot for these credits that they might want to develop. So there's potential for small landowners to develop projects. There are improving methodologies and protocols that are helping small landowners gain access, but there's still the hurdle of finding markets for those credits. And they're not really any different than the hurdles anyone would face in a compliance project, but it still is kind of the biggest problem right now for the small landowner. They hear about carbon, they hear about their neighbors who maybe have developed a carbon project and they want to do it, but it's still not a fully developed market, the voluntary market for carbon offsets. And I think that's something that, I know the Climate Action Reserve and the American Carbon Registry are working on, creating better methodologies and protocols, but I think the marketplace is still a place, is an aspect of this that could use, that could be improved. And even someone like myself who develops carbon projects, finding access to voluntary buyers is a struggle, and it's not easy. So let's see. I think that pretty much wraps up, kind of my introduction to what I've been doing and kind of where I see, my clients and moving in the carbon space.
Thanks so much, Jim, for that. It was really interesting, and we are getting some really great questions coming in. I think maybe I'll ask a quick clarifying question before we move on to the next speaker. And just to note that we do have additional questions, so thanks so much to those that have put them in, and we'll have more of a discussion at the end. But one important question that we have here is about the topic of additionality.
Sure.
And I thought maybe you could clarify for the audience how additionality works in the projects that you've done, particularly when you're mentioning, it sounds like you were referring to some landowners that are above common practice and
right.
that you're determining additionality. Can you explain that to everyone in that case, how that's considered in that type of additionality and how that's calculated? Because in other types of projects or other methods, like modeling a scenario into the future and then changing your practice based on that, can you just clarify the distinction in how that is measured?
Sure. Yeah, I mean, when I mentioned clients taking credit for good work they've already done, that's exactly right. Those are clients who've allowed their forest to develop into a condition that exceeds kind of the average, average condition across, private land holdings in the forest type that they manage. So that is a component of additionality, because you are allowed to take credit for how your practices or where your stands are in relation to it. I mean, if you're talking about common practice, you're talking about the California Air Resources Board or some of the Climate Action Reserve's other project types for improved forest management, which set a common practice at kind of a stocking level of the average of private timberlands in that assessment area. So if you're in the Redwood region, it's private timberlands in that region, and that's the lowest level at which you can claim kind of where you could take your stocks to. And in a lot of places, or for a lot of timberlands that have been well managed and not over harvested, they could take their stocking well below that. So by implementing a carbon project, they're actually giving up a little bit, because they're, if they could harvest, they could go below common practice, but they're not going to, because they're agreeing to, kind of create a benchmark there where they're not going to go any lower. So if your stocks are high, common practice is below that, you can immediately take credit for kind of the fact that your stocks are above common practice. You have to demonstrate that you could manage your stands down to a level that would be similar to common practice. And that's part of the project development, and that's part of the verification, is to explain to the verifier how you did that and document it. So that's kind of, there's two parts to any carbon project. If you're above common practice, you get this initial kind of carbon benefit, which is the fact that you're above it. And then going forward, you're agreeing to maintain it at where you are now. So that's the improved forest management part of it. You're basically saying, we are going to manage our stands at this level or above, and we're going to get credit for anything that we sequester going forward, but we're also getting credit for the fact that that our stands are in a condition that exceeds common practice. And that's not common practice isn't it, that's only a couple protocol types. Other protocol types have a business as usual. That's another name for common practice. It's like what would have happened on the forest. They're guided by maybe maximizing net present value, which in Mendocino County, landowners don't maximize for net present value. I guarantee you that, because they're mostly small landowners. They're not industrial timber holdings that are trying to make a 3% return or maximum. So if that, I mean, those are great ways to talk about it, but in reality, that's not what happens. Landowners manage for a lot of different reasons, and they don't harvest for other reasons. And so the additionality is that. I mean, I hope I've explained that. I know it's a long roundabout way of explaining that.
Well, I think the key point is that for those that are interested, it's this idea of common practice that you are referring to in that specific case, but there are methodologies that use a different approach, and the voluntary markets does depend a lot because they're not there's just different methodologies and an opportunity, and especially in international context where you don't have the common practice capabilities with FIA data. So just to say that there's some methodological differences, but thanks. Actually a ton of questions for you. So your comments have drawn a lot of interest, but we're going to move on right now to Karsten. So I'll hand it over to her and take it away, Karsten, and I'll be back with a question for you.
Hello. I'm just going to remark that I think that this whole Zoom adaptation is so disruptive and so accepting all at the same time, to be sitting with my little talking head on a screen and not seeing any of you. So my name is Kirsten, and I'm really excited actually to be here today and to talk a little bit. I looked at the title of the session and I think it's really timely. And Jim, I think you did a great job kind of as an introduction of addressing, even though I don't know if it was your intention, about the innovation that has occurred in carbon markets over the last 30 years. And the conversations are never static. They're always dynamic. My bio started sort of, with my past, which is that I spent over 20 years with Timberland Investment Management Organization, developing carbon projects primarily on naturally regenerating hardwood forests, kind of over the course of the time. Started on the early action and voluntary, then went into the compliance market with CARB, developed 19 projects there, generated over 15 million credits, and have very recently moved over to the other side. And I'm now working for the Pacific Forest Trust, which from a scale perspective is smaller. However, from a critical importance perspective, I think is even more focused on the mission of how offsets can continue to create kind of radical climate solutions as we all work in these watersheds and in these forests, and figure out ways to get all the multiple benefits. So the Pacific Forest Trust is where I'm going to start, since that's where I am. But as we go over to questions and answers, I'm happy to talk about kind of my other side at the transaction table and how an investment group used carbon credits and thought about carbon credits from a monetization perspective, as Jim mentioned, because I did a lot of that. But on the land trust side, the Pacific Forest Trust actually was founded in 1993, and the co-founders, since inception, were sort of what I would call daring and savvy at looking at the way that our market forces could create economic incentives for private forest landowners to both conserve their land and continue to keep that land in working forest. So they started were actively involved in this protocol development in 2002 with what was called the SHARE Bill, or the SURE Bill in California. And that added forest at the time as an offset role when California was really starting to think about climate mitigation and cap and trade. And Connie and Lori, who are the co-founders, acknowledged that forests were both contributors to CO2 emissions in terms of degradation and forest loss, but they also were probably one of the best natural sinks that we had in terms of mitigating the climate change and climate change effects going forward. So it all sort of started in 2002 with the Share Bill, and then by 2006, AB 32 was adopted, the Global Warming Solutions Act of 2006. That shifted to a compliance regime, which asked CARB to revise the offset standards, embedding these kind of what, again, Jim talked about, these baseline assumptions, the ideas of additionality, the ideas of permanence, and sort of before then, an offset was an offset. And there's been this diversification, and it's kind of come full circle, I think, in terms of it was early action, it was voluntary. Then we had this compliance grade market with a promulgated, AB 32. And then again, the secondary promulgated law with, cap and trade and the protocols that were adopted and really rigorous standards. And I'm happy to talk to those too with sort of questions and answer section on both sides. But I will say that the Van Eck Forest, which is owned and managed by the Van Eck Foundation and managed by the Pacific Forest Trust, was one of the first projects that moved from voluntary to regulatory market. And from a Pacific Forest Trust perspective, it gave the land trust an opportunity to sort of, I will just say, speak and practice at the same time as they were, talking about allometric equations and baselines and all of these things that now, 20, 25 years later, I think is part of the innovation name of this session, but also some of the more rigorous standards and practices that kind of set the idea and the tone for offsets. So Pacific Forest Trust continues to pursue offsets. I think that there's a bias against some of the dilution on the voluntary side that has adapted, as most markets do, to shorter timeframes, less rigorous standards. And we've been in conversation about many of those, and I for sure have been in conversation with owners and buyers and purchasers of those voluntary markets and those brands and what those projects mean. But the Pacific Forest Trust continues to be really focused on climate change in what we call the Klamath Cascade region. So it's the part of Northern California. It's the primary source of California's most critical natural resource, which is water, which happens to really be, a co-benefit of forestry and of climate as well. So in the Klamath Cascade region, there's over 100 million acres that arc from sort of Mount Lassen across Northern California to the headwaters of the Klamath River. And that is where most of our work and carbon projects included are focused. And so while we are conserving mostly with working forest conservation easements, focused on making sure that the engine of the forest continues to be healthy and continues to drive the offset market. So while an offset, a metric ton of carbon equivalent is the product that is being developed and sold, we continue to be really focused on preserving the integrity of the forest that offset has left behind. And that is where our focus continues to be, recognizing, and I think, Jim, you mentioned this too, that as for the scope of needs in terms of capital requirements, in terms of hurdle rates, in terms of keeping forests working forest, which is everyone's dream and desire, is really different if you're a woodlot owner or a non-industrial private landowner, or if you are an industrial, fully vertically integrated forest company, or a TMO that has a bunch of investment stakeholders that are really concerned more about what the internal rate of return is, rather than how that healthy forest system is continuing to thrive and protect our climate and our water and our watersheds. So The Pacific Forest Trust vision as a land trust and as a participant in this market is to continue to have an integrated, a diverse forest economy where the investing dollars are coming and conserving the water resources, the watersheds, the forests, and we see and will continue to see climate as a driving force behind offsets in the cap and trade market in California and regional participation across all of that, but really not losing sight of the forest through the trees, which is that for an offset to be effective and an effective market mechanism generating an alternative source of capital, we have to continue to keep the forests that are generating those offsets as healthy as we can and as healthy as they can be, which is why we will always advocate for a regulatory grade offset that has all the things that we talked about: permanence, looks at additionality, looks at the baseline, but most importantly, covers the commitment for the 100 years. And and I'm happy to talk about this at the end too with questions, but there are a lot of products that are coming to market in the voluntary space with the American Carbon Registry generating their own standards, and RED, which is down in Central America. I've done a lot of work down there on standards, and BCS, where they have these shorter time horizons. And I think that's where a lot of kind of the integrity of the offset program is getting some criticism. And back to the innovation point of this panel, I think innovation is a really natural byproduct of any market and of any system. And of course, carbon offsets are going to be innovating in that space as well. And there's different ways to do it, but the Pacific Forest Trust will always put our weight and our dollar and our policy and our legislation behind the California sort of rigor, and acknowledging that if there's going to be other regional markets, either in Oregon or Washington or the Northeast part of RGGI, that we do have to look at that 100-year commitment. Because if a forest is depleted on a carbon side, if you look at the modeling, the ripest time for sort of torrential damage is at 20 to 40 years. And so I'm not a biometrician, but I'm happy to talk about models as well from a carbon sequestration perspective about why that long-term commitment is a really important part of offsets, even while we're looking at innovation. And with that, I'll wrap it up and pass it on to the next speaker.
Thanks so much, Kirsten, and saying your name correctly at the beginning of this. That was super interesting. And I do think we have a really wide range of questions here that you'll be able to respond to. But since I don't have super clear immediate clarification, maybe I'll save some of these like bigger questions for the end for you, and hand it over to Dan right now to share his presentation. I'm not our cameras on or off. I just got a note that we should maybe turn them on, but I know Dan, you're going to share slides, so we'll have to see how this works. I might turn them off for a minute. We can see if that makes a little more space for your slides, and then we'll all have our cameras on for the discussion at the end. But take it away.
That sounds great. Thanks so much. And I do have some slides to share. So as Lauren mentioned, I'm Dan Sanchez. I'm a faculty member at UC Berkeley in the Department of Environmental Science, Policy and Management. And I spend a lot of time thinking about biomass, bioenergy, innovative wood products, and thinking about the carbon and economic drivers of those innovative wood products. So I'm going to come in today and talk about a slightly different model of improved forest management, but still kind of keep the focus on the state of California, where I do most of my research and where I do most of my work to support technology developers and policymakers. And the reason why I'm interested in doing this is because I think there's a fundamental distinction and difference between in-forest carbon storage, which is the direction and the focus of the vast majority of existing forest carbon and IFM offsets, much like what Jim spoke about earlier. And then a version of carbon storage that considers carbon stored in wood products, that considers the displacement of fossil fuels if you're making different products out of this wood, and the broader kind of economy-wide interactions. So this is some work that's particularly focused on working forests. Let me bring that up. Great. So, what I'm really interested in, in its broadest sense, is this idea of whether or not innovative wood products can help California meet its climate change mitigation and adaptation goals. Now, I don't think many of you need to be reminded about the situation we have with the catastrophic and severe wildfire in the state of California. But we did have 5 million acres burned last year in the year of 2020 during the 2020 fire season, including a gigafire that was over 1 million acres burned. And there's substantial CO2 emissions release on the order of tens to hundreds of millions of tons of CO2 equivalent from those wildfires. We also know that California really does need to deal with a legacy of overstocked forest and a fairly depressed forest products industry. And particularly because of the wildfire risks that we're facing, there's a real need to drive forest restoration, which primarily involves not only prescribed burning, but also the mechanical treatment and removal of typically small diameter vegetation and low value wood from the forest to reduce its wildfire risk, but also maintain carbon standing in large trees. So I'm, really interested in understanding if there are new wood products that we can make, that we could introduce in the state of California that can attract higher prices for this typically low value wood. That wood is typically, especially if it's, a smaller tree or a top or a branch, is piled and burned at the end of a forest management project, rather than mobilized to create some kind of beneficial product. Second question I really want to understand is whether if these new markets and these new products would have an impact on forest management and fire risk across the state of California. And then finally, really trying to understand the ultimate carbon impacts, thinking not just about the in-forest carbon storage that is the real focus, I think, of most IFM protocols, but really considering the harvested wood products component of the IFM protocols and the carbon benefits that can come from new and additional wood products. So I want to say, this is an early figure, but what we're showing here is essentially the internal rate of return of different innovative wood products that we might try to introduce to the state of California, and what they might mean in terms of a delivered feedstock price, how much you could pay per bone dry ton of delivered feedstock to the facility, and still make an acceptable rate of return. We think that there are a range of opportunities, not only in kind of new engineered wood products and structural building materials, things like oriented strand board, which is primarily produced and very predominant in the eastern United States, but not produced in the western United States. Along with a range of other low carbon or even carbon removing transportation fuels, things like renewable natural gas, things like drop-in gasoline or drop-in diesel, even an opportunity to maybe run our vehicles on things like hydrogen in the state. And again, we think that these innovative wood products will bring, will hopefully provide a financial incentive for increased forest restoration and increased mechanical thinning on California forests. We then work through, kind of really understanding the overall outcome of this forest management across a couple of different scenarios. Just to walk you from the three scenarios we consider from left to right. The first figure tracks the carbon storage over a 40-year period at current levels of management within the state, which is, a few 100,000 acres per year, but far below the 1 million acres per year that both the state and the federal government have committed to in terms of driving forest restoration, in California. Our next scenario actually does consider 1 million acres of management per year, but it assumes that we're using the same mix of wood products that we're using in kind of our conventional business as usual. That means that, saw logs go to create dense-dimensional lumber. Much of that goes into buildings, but tops, branches, and small diameter trees are a little bit is used to make biopower, typically in fairly old biomass power plants. But no kind of advanced uses of these wood products. Now, when we consider actually doing 1 million acres of management per year and a full suite of innovative wood products, things like low carbon and carbon negative fuels, as well as structural building materials, things like glulam or cross-laminated timber, we see that these forests really have the best net economy-wide outcome. And it is because of a few things. We see that, of course, there is less standing carbon in the forest, in part because of harvesting, but we also see large substitution and storage benefits, particularly from things like conventional timber products, as well as a reduction in wildfire risk, which including both combustion and the post-fire decay for these forests. So we're excited about this opportunity to deploy innovative wood products in California and meet and kind of realize the carbon benefits that can come from that. One thing that we are super interested in is the idea that we can use wood that would typically be chipped or piled and burned, sometimes used in biomass power plants, to again make these transportation fuels, including transportation fuels made with the technology known as carbon capture and sequestration. What that allows you to do is, by capturing the CO2 that comes from converting biomass into fuels and injecting it underground in deep geologic formations, you can improve the amount of CO2 that is being permanently held out of the atmosphere, and therefore reap very large carbon benefits. And there's a lot of focus and interest in the state right now on new and emerging fuels like carbon negative hydrogen, low carbon renewable natural gas, as well as, of course, liquid fuels as well. And just to show you some of the impacts that we have when we're considering this scenario, where instead of doing a few 100,000 acres per year, we're really meeting a 1 million acre per year management goal, and also using that as a driver to restore our forest and for mechanical vegetation thinning. And we find really good outcomes in terms of the amount of wildfire risk reduction we have. Over our study period, we reduced the acreage of stand replacing fire by about 40% when we step up this level of management, and we see really large benefits, particularly in the Western Sierras, as well as some of our other Doug fir forests, like the Mendocino National Forest. And this is where we typically have some of the highest fire risk in the state of California. So I want to stop there and just say that I think there's a lot we're learning, and there's a lot that can really that we can take on and think about when we think about kind of really improve forest management in its broadest context, and we think about the carbon benefits and the carbon trade-offs involved between harvesting, management, growth, and wood products. I think this is a space that's going to keep on evolving, and I really do hope that that wood products in particular are a central part of how we do the carbon math and how we hopefully realize carbon benefits from forests in California and across temperate regions around the world. I'll stop there. Thank you.
That was great. Really interesting framing of thinking about carbon in truly innovative new ways. So really appreciate that. So now we'll transition into addressing some of the really great questions that we have here. And so I'll just ask on their cameras, and I will kind of get a little bit of a conversation going. So I'm going to start off with a question that I think is most relevant to Kirsten and Jim, perhaps. I'm hoping that you can speak to the price expectation that you're currently seeing for forest carbon projects. And so both in the compliance market, which there's a lot more information on, but also in the voluntary market, which seems to be difficult to find a set number on that. Could you unpack that a little bit for us?
Do you want to start, Jim, or would you like me to start?
Sure. I mean, I can. That's the thing with the voluntary market. Because you have to find your buyer. There's a kind of a broad range of prices that are paid for voluntary credits. Some early credits we're selling for $15. It really depends on how well you convince your buyer, that how great your credits are. If you have other aspects of your project that make them more interesting, like if you're saving old growth, or if it's a redwood forest as opposed to a ponderosa pine, or it has some other co-benefits, like protects spotted owl habitat, is in a watershed with coho salmon or steelhead, it has, those are things that that drive voluntary prices more than they do, compliance prices, which are just based on credits issued, and comes down to additionality and complying with the protocol. But those other aspects don't come into play. But I mean, right now, I think I'm hearing, prices, in the $8 range. Yeah, I mean, obviously the buyers don't want to pay too much and the landowners want more, but I think that those kind of prices can work. I mean, when you get down into like $5 and $6, I think it gets hard to unless you have really huge projects. And I mean, again, that also makes it harder for small landowners as the price goes down. But I mean, that's kind of the prices I'm hearing. Again, that's one of the big hurdles for any small landowner or even a moderately sized landowner is, trying to get access to that market and find out what those prices are.
I'll go ahead and I'll follow up with Jim's comments. I think I sort of put the credits in 3 buckets. There's the regulatory credit, which is generally traded at a discount to the allowance prices, and the allowance prices are generally driven by the auction and the supply and demand dynamics there. I will say that sort of the range between 2012 and 2021 has been, I think we started trading at, $8.95. Maybe those were early action credits that were in line to become regulatory credits. And probably the highest price that we traded for would have been maybe 2018-ish, and we sold credits, regulatory grade credits to offsetters. Again, for them, those dynamics were largely dependent on their own sort of secondary markets and some speculatory hedging. There's a whole secondary offset trading market that isn't just a one-to-one for a polluter. So those were sensitive to perhaps hedges that they had made themselves. And if the project was delayed in issuance and they were on the hook from a volume perspective for 200,000, credits to a secondary buyer, they may have come to the market and spend, 16. I think 16 was probably the highest that we transacted at. But I will say that those transactions were probably subject to these secondary dynamics, even though the purchaser may not have been that forthcoming about it. I think that sort of the second price tier is what I will just call is a voluntary commodity grade credits, and those are some of the red credits that have come out of some of the countries in Africa where millions, hundreds of thousands of credits were generated, and you can call up a broker and you can buy them for $1.50 maybe to $3. But they're not necessarily tied to a project, or if they're tied to a project, it's much more of it's what I call commodity credits. And then the third bucket of credits where there really is the most variability are voluntary credits that really have a landscape narrative and story to tell around the projects. And some of those are carbon standard credits or red credits in Central America, even some ACR credits, that are, sort of offshoots into that voluntary space. And the price per metric ton equivalent offset in those markets can be so variable, and it completely depends on scale and on volume. So I would say, generally, if you kind of looked at the index, they're trading between 10 and 15. But there are buyers that have paid as much as, $35 to $75 to even $100, because what it is that they're selling oftentimes is the co-benefit on the goodwill story. And it's not really an offset as a 1 metric ton equivalent. It's a goodwill narrative benefit to how that particular polluter or that particular company it's working for net, a net zero impact, how much they're willing to pay for that. And that's really a willingness to pay. It's almost a transaction that's outside of any kind of indexed, tracked, or, even price series, because they're proprietary, they're voluntary, and it's me as the generator of the credit, and whoever I'm transacting with on the other side. And it just depends on what their needs and demands are and what they want to share and and bump up in terms of the narrative and the story and what it is that they're doing.
That's really helpful, and that actually resonates with some things I've heard, that sometimes these lower prices for voluntary credits are kind of thrown around, but then what I'm hearing from project developers is that in fact they find that prices can be consistently higher than the compliance market, but it depends on those relationships and having the agreements in place. So it sounds like a lot of variability there. Really, really insightful. Thanks for sharing that. I'm wondering if we can transition into a conversation to kind of connect the dots here between the themes that you all spoke on. And we are hearing a lot about the role of innovative harvested wood products, conversations about mass timber, long-term carbon storage. And so I'm wondering if we can kind of unpack this theme. And so Dan, your work is more on this modeling and research side of things. And I'm where's your understanding currently of how that can connect to carbon markets? And then if maybe Jim or Kirsten can jump in with their methodological expertise and speak to that. How are the credits in harvested wood products handled in projects today? And what do you see as the connection between Dan's work and where those harvested wood products might be going and how that could change the future for carbon credits? So maybe Dan, start with you on that, and then Kirsten or Jim could jump in.
Sure. And I can speak mostly within the context of the California Improved Forest Management compliance offsets that are, actually sold within California's cap and trade system. What these projects have you do is essentially you define a baseline, and then you define your outcome. And over the course of about 100 years, or the length of the project, and then the time following, you need to model the overall carbon benefits of your project. Now that includes both in-forest carbon storage and harvested wood products. My understanding is that harvested wood products accounting right now, it doesn't have this, really nuanced view about product mix and sawmill utilization and, and kind of a fuller accounting and of the very product specific choices that you could make when you're doing harvesting. But again, my initial look at IFM protocol says there's no reason why that couldn't be integrated. Obviously you will need to consistently account for forest carbon stored in products versus forest carbon stored in the forest, and you can't just make up carbon. But you should be able to, accurately account for both of those carbon benefits and set up IFM projects that generate offsets from it.
Thanks. And so could maybe we hear from Jim or Kirsten about how are harvested wood products currently considered? Do you see that being a possibility to have additional benefit from calculating longer carbon storage in some of these innovative products? Any thoughts on that from either of you?
I'll speak first because I have not a lot to say, and then maybe Jim can expand on my conversations because I think that he's a little bit more intimately involved with it. But my response to that one is really, really high level, and that is that that the carbon calculation that goes in the long-lived wood products, again, is one sort of immaterial calculation, and while we get credit for it, the long-term driving engine is the forest that's in the trees that are growing the additional carbon sequestration, right? The live part of it. And I think that you can get really in the weeds with builders and with architects when you look at mass timber and you look at these all different alternatives that wood is good and how much carbon it's storing. And it's true, long-lived wood products does store carbon, but it's the trees that were left behind, the pieces of lumber that went to the mill that sort of sacrificed themselves for that, from a carbon perspective, if I can be poetic, for the lumber, that's really the driver. So I think we could come up with all kinds of calculations and ratios to maybe particular, try to give us more based on an improved forest management perspective. But the materiality is really, from my perspective, and again, I'm not a biometrician, and don't talk to me about allometric equations at the top of a cherry tree, because that's not my core competency. But I know that that's where the materiality is. It's not in the lumber that gets on the truck that then becomes a part of a wood versus steel versus concrete building in an urban center. That's I know enough to be dangerous.
Yeah, and I would agree with that. Right now, the current protocols really just deal with in-use and landfill when it comes to carbon stored in wood products, and they are a very small part of any annual reporting. I mean, they do come into play with regard to secondary effects, and if you don't harvest, you do have to take a penalty for not harvesting, and that's where the wood products calculations do come in. So that's kind of their biggest impact on any current carbon project. So, but I do see, I mean, you're not going to bring new wood products accounting into existing protocols. So that just doesn't happen because you don't change protocols. Projects kind of locked into the protocol. So, but I think there's a lot of opportunity to look into more innovative ways to include carbon accounting for other types of uses that aren't stored, in use, like biofuels, or, I think that's a great opportunity, because the real benefit of those types of uses is that they get rid of, all of these small trees, and they would encourage people to do thinnings, and, if they could take that wood and use it. I mean, I think the carbon accounting is the smallest part of anything. I mean, having a use for that material would be the biggest benefit for any landowner. If they had a biofuel facility they could deliver waste product to that they normally would just leave out there, that would have a huge carbon benefit, and it would also work to reduce fuel loads and fire hazard and all the other things that we need to do in our forests. I don't know how the carbon accounting would work. Again, I am very technical, but my knowledge is limited to kind of these protocols I operate in. I mean, I'm not out there on the cutting edge of, like Dan is in terms of, what might be possible.
That's really helpful. And actually, I think that does point to a kind of a current challenge that we have with a lot of professionals working in this. There seems to be quite a divide from the forest to the forest product space, and getting that kind of clear understanding of how we should be thinking about carbon across the board. So with that, we have just a few minutes. I'm wondering if we can do just a kind of a quick round robin before we wrap up today to maybe just share with us, what do you think we can see in terms of like the biggest innovation or the biggest changes in the next 5 to 10 years in your work? If you can think of like something that could be a shift from the way things currently are, or an area that you see a lot of growth or excitement. If you could each think of something along those lines, I think that would be really helpful before we wrap up. Does anyone have an idea right away?
Well, I mean, I would think that,
Go ahead, Jim.
Yeah, protocols and methodologies that give access to smaller landowners, and so they can participate in taking credit for ecological services, whether it's carbon or other benefits from their forest lands, so that they can maintain their forest lands and open space. I mean, I think to me that's what I'd like to see.
Great, thank you.
Great, and I'm going to cheat and say two things. I think everything Jim and Karsten said around changing protocols and thinking about innovative uses is going to be the main thing that I think can really happen in carbon markets. But I do think that some of the raising and kind of persistent concerns around both additionality and leakage, and some of the critiques that we're going to start seeing, both in kind of anecdotal but also protocol-wide examinations, I think that's the real wild card for IFM and for carbon offsets from forestry in general. Is there a backlash? Is there a tightening of standards in the response to some of these concerns that are increasingly getting raised?
Thanks, Dan.
I'm gonna bring us up a level even above the forests, and I think that the most innovative to happen is that we we lived and worked in an economy that actually accounted for carbon emissions in a true market way. I feel like I'm thrilled that there's a market for offsets. I think it's fantastic. I think it's one tool. I think it's one mechanism. I think it's created additional cash flows, free cash flows, and hence, higher hurdle rates and IRRs for people, and even for small landowners, perhaps. But I would love to live in a space where the true impact of all of the negative externalities that come from carbon emissions really is captured at a magnitude that can drive market force-based solutions that really move the needle for saving forests from fragmentation and conversion, and in turn creates a real market around scarcity for all the things that come from forests. Water, for example. I think we spend a lot of time focused on the offsets, and if an offset sold for $45 or $100 a ton, that would compound the value for the forests that were generating those offsets and help us really think about a market for our ecosystems and our ecological services, because that's a conversation that I'm really excited to have.
Well, that is a very awesome place to end our conversation today. Thank you so much to Jim and Kirsten and Dan for sharing your expertise with us, your insights, your experiences. I think this was really insightful, and it was great to have this discussion with you all today. And a big thank you to everyone who shared a little time with us this afternoon. I really enjoyed it, and I appreciate the time you all put in today. So thanks so much, everyone. Take care. Yeah, thank you.
Okay.
Thanks, everyone.
Bye-bye.
Bye.